Michael Burry. This is 10 times worse than a recession. Michael Burry, a well-known investor, has recently made a prediction that has sent shockwaves through the financial world. He believes that we are heading back to a period reminiscent of the 1970s. This prediction comes at a time when the jobless rate in many areas is alarmingly high, with the statewide rate reaching 9.3%. Local unemployment offices are struggling to cope with the influx of job seekers, highlighting the severity of the situation. To add to the concern, a significant change will take place soon. Gasless Sundays will be implemented. This shift is expected to evoke memories of the past and prompt people to embrace the lifestyle and habits of previous generations. It is an indicator of the challenging times we are facing. The 1970s were a decade filled with uncertainty and turmoil. It was a time of stock market instability, with a drastic 50% decline occurring within just 20 months. Unemployment soared and prices skyrocketed, creating a sense of unease that persisted throughout the entire decade. These events left a lasting impact on the economy and society as a whole. Michael Burry's prediction that we are on the verge of reliving this unsettling period is a sobering thought. While some may find it alarming, it serves as a reminder that history tends to repeat itself. The patterns and behaviors that shaped the 1970s can resurface in today's world, impacting our economy and daily lives. It is essential to closely monitor the situation and stay informed about the potential implications of these predictions. As we navigate through these uncertain times, it is crucial to adapt and make informed decisions based on thorough research and analysis. History tends to repeat itself because people's behavior doesn't change much. Michael Burry has studied the 1970s extensively and believes that similar patterns will happen again. Although inflation has slowed down recently, many think it will fade away as we enter a recession. The committee's decision to raise the federal funds rate target range indicates a shift in response to slower inflation. People assume that once prices drop and the economy bounces back, the crisis will be resolved. But Burry sees something others don't. He questions how we'll recover from this recession and what will drive the change, as there don't seem to be any clear strategies or forces at play. Burry predicts an extended recession that will last for several years, which may be hard for some to grasp. To help understand this, think of the economy as a bathtub. The water level represents economic activity, and the top means things are going well, while the bottom signifies a recession. Ideally, we want the water level somewhere in the middle to top range. Due to the pandemic, the water level dropped to the bottom, and the Federal Reserve tried to fix it by adding water, but it overflowed. Now, the Fed is taking water out, bringing the level back to the bottom. However, they didn't consider the water that spilled all over the restroom, representing the lasting effects of the crisis. Now, picture some of the water spilling onto the floor. That spilled water represents something important that many people overlook. It's called money velocity. Let me explain what that means. Money velocity is all about how quickly each dollar gets spent on things like buying goods and services. Right now, because we're in a recession, people are holding on to their money. They're not spending it as much as before. But if prices were to drop suddenly, people would start buying things again. This would make money move more quickly from one person to another, increasing money velocity. Here's the catch. If prices drop and money velocity increases too much, prices might start going up again. This would lead to another wave of inflation, just like what happened in the 1970s. Back then, even though the Federal Reserve tried to control the amount of money in circulation, money velocity rose so fast that inflation soared over 14%. It was a time when prices kept going up, and at the same time, more people were losing their jobs. You can see the impact of these economic challenges in real-life situations, like people waiting in long lines at employment offices, desperately looking for jobs. It was a tough time for many. On top of all this, there's another concern. The Federal Reserve might suddenly start printing more money again, which could make the situation even more complicated. According to Burry, inflation is likely to slow down from June to December 2023, possibly even reaching negative levels. This will be influenced by the Federal Reserve raising interest rates. However, the velocity of money, which represents how quickly money is spent, is not expected to pick up until 2024. Before that happens, Burry predicts that the Fed and the government will start printing more money, causing inflation to spike again, similar to what happened in the late 1970s. Burry has some concerns about the current economic situation. He questions the continuation of the temporary income tax cuts from 1975, which have boosted workers' paychecks. He argues that many unemployed individuals are voluntarily staying jobless because they can afford to wait for better job opportunities due to unemployment insurance. As a result, there are more job openings available, but farmers are struggling to find workers to pick their fruit. Despite inflation already reaching its peak, Burry believes it's not the end of the cycle. He expects the Consumer Price Index, or CPI, to decrease, possibly becoming negative in the second half of 2023, indicating a recession in the United States. In response, he predicts that the Fed will lower interest rates and the government will take steps to stimulate the economy, resulting in another wave of inflation. Burry points out similarities between the current situation and historical events like the 1970s and the dot-com bubble. He criticizes the actions of the Federal Reserve, accusing them of selling stocks at the peak of the 2021 bubble. He highlights similarities such as high number of initial public offerings, or IPOs, speculative cryptocurrencies, and fraudulent schemes. Despite these similarities, Burry clarifies that he is not currently betting against the market. He explains that he has more investments in assets expected to perform well in the current economic environment, rather than taking positions that would benefit from a market decline. Currently, we are experiencing a combination of inflation and economic contraction, which can be challenging for investors. In such times, gold is often seen as a safe asset to protect against the effects of this economic climate, especially when compared to currencies like the dollar. While cryptocurrencies like Bitcoin were once considered competitors to gold, their recent poor performance has actually made gold more appealing as an investment. Michael Burry, a well-known investor, believes that as cryptocurrency scandals unfold and converge, it may further increase the attractiveness of gold. High cash flow businesses are another type of investment that frequently performs well in this type of scenario. These enterprises can be found in two areas, including Hong Kong stock exchanges, according to Burry. Burry sees big prospects in the Hong Kong market despite worries about it because of its relationship to China. Since many Hong Kong residents consider the stock market to be dangerous, they frequently invest in bonds and real estate instead. As a result, as compared to the US market, the Hong Kong stock market is undervalued. With a growth rate of 3.3%, economists are getting increasingly upbeat about Hong Kong's economy. Burry emphasizes that the valuation ratios of the Hong Kong Hang Seng Index are currently trading at historically low levels, indicating that the market is undervalued. While some may have doubts about investing in the Hong Kong market, it is worth considering. Similarly, in addition to Hong Kong stocks, Burry has been acquiring US stocks that have high cash flow yields. These companies possess specific characteristics such as low valuation, strong cash flow, and significant debt. Burry believes that these cash flow-oriented businesses present a buying opportunity, similar to what was seen after the dot-com crash. He points out that the companies with substantial leverage but strong cash flow and effective debt management can reduce their debt at a significant discount, making them attractive investments. An example of a company in Burry's portfolio is the Geo Group, which operates private prison facilities. Although the business model of the Geo Group is controversial, it possesses the desired characteristics of high cash flow, low valuation, a high debt-to-equity ratio, and a strong competitive position. Whether or not one agrees with Burry's investment thesis and specific choices is subjective. It is crucial to conduct thorough research and analysis before making any investment decisions. Understanding the current economic situation and carefully evaluating investment options can help individuals make informed choices that align with their financial goals.